All right. Hey there, Rockstar. So I see I'm about 20 minutes late. I actually thought I was about 10 minutes early, so I got my times messed up there. So I wasn't sure if we just cancel it all together or do we go back or do I wait for 10 more minutes and start at the bottom of the hour? Well, I just thought I'd go ahead and start in case any of y'all were wondering where I was, and sorry to do that to you. But I want to talk today, let's see, about the pending housing bubble. More and more people are on the doom and gloom side of things, and they seem to rear their uh, heads every single day and share their new predictions. But there's one particular person that did predict the crash of 2000, did predict the crash of 2008. And so, what does he have to say about today? What does he have to say about now? So, I want to go ahead and show you an article that was just released and what he is predicting so you can plan accordingly, or you can take it with a grain of salt and stay the path of what you were doing. But before I do, I want to real quick reminder: this Saturday's live virtual workshop. We're going to be going in depth on this subject, also on how to navigate this market as a real estate investor. And if you'd like some more info, you can head over to flipthescriptworkshop.com. And if you like what you see, go ahead and join us. I put a link down in the description below, and there's some information down in the description below as well. All right, so let me share my screen with you real quick, and I'll show you what I was talking about here. Perfect. Okay. So we're talking about Mr. Let's see, Robert Schiller. So he predicted the 2008 bubble. And so his call for 2022, everyone is kind of like all ears because he also predicted the 2000.com bubble as well. And so he released a book about it in 2000, predict and called it, and released another book, Is There a Bubble in the Housing Market? Late 2004, and by 2007, boom, we know what happened, right? So the article goes, as the pandemic here has the pandemic housing boom, which has pushed up U.S. home prices by 42% over the past 2 years, as it starts to fizzle out, it raises the question, does Schiller think we're in another housing bubble? So on Sunday, he spoke to Yahoo Finance, and he told the outlet that he once again thinks the U.S. housing market is headed for trouble. And his reasoning is home prices haven't fallen since the 2007-2009 recession. And right now, things look almost as bad. Existing home sales are down, permits are down, a lot of signs that we'll see something. And it may not be catastrophic, but it's time to consider that. A drop in home prices, he says, looks very possible. Well, I don't think anyone is really debating whether or not we're going to have a drop in home prices. We're all thinking there's going to be a little bit of correction. There's certainly some slowing down, but at the moment, we are still appreciating. So the U.S. home price, there was a one stat in here that I hadn't seen before and I didn't realize. So it shows the where was it? The risks are heightened right now for buying a house. Let's see, is right here. The new home price, or excuse me, the new housing. I'm sorry, I'm mixing messages here. So the new home builds, right? So we've always been talking about how the demand, or excuse me, the supply is so low, and new home builders haven't been building at the rate that they needed to, and we've seen a rapid decline here in just last 4 or 5 months, where the building permits just dropped, right? And so builders almost stopped. But what I wasn't aware of was how much building had already started. So there was quite a bit of building that had started, and the last stat that I saw was that there is 9 months of inventory of new houses. And that sounds scary. It's like, oh my God, that takes us right into a buyer's market, and that is the recipe for a bubble. But with that said, of that 9 months of inventory, a lot of those houses haven't even been started yet. The permits were pulled, so technically the inventory is there, but with the cost of labor, the cost of supplies, the whole supply chain thing, they actually haven't been started. Although they are there, or they've been started, but they're not continuing to build them right now. So they've totally stopped. So when you see like this whole article right here, he's talking about how the home builders might be getting hurt because they have all these projects going on that they can't finish. So they're going to get hurt. But is it really going to impact the housing market? Is it going to impact you? What does this mean for investors? So he goes on to say that every bubble has a few things in common. And the first thing he's talking about is speculation. And we know in 2008, that was a big deal. There was a the builders were building like crazy and people were buying houses like crazy. And what happened was we had too many houses and we just didn't have enough people to fill them. So you can see this chart right here of US home flips. And we had a bunch of new stuff hit right here. It got started here in the first quarter of 2022. And that has come to a drastic slowdown, almost a dead stop. So he thinks there's a lot of speculation here. I don't think there is a lot of speculation because in 2008, we had more houses than people. And right now, we have more people than we've got houses available to live in, even though the new home builds are and the new housing starts and all the new home builders are getting stuck with all this inventory. They're not ready to move in yet. They're not ready to move into, and they've stopped building because they can't see a way out of how they're going to make a profit. So they've kind of stopped everything. So that's the first thing. The second ingredient that he's talking about, and this is a little bit misleading as well, I think. The second element is over-evaluation. So a housing bubble sees home prices go far beyond what incomes historically would support. And we're seeing that, like these housing prices in middle America are so high that, but the average income for those areas don't have the income or the job opportunity to support those housing prices. But what has happened is so many people have moved from the West Coast and from the East Coast, and they've all moved inward, and they've got a bunch of money. They're working remotely, so it looks like they are overvalued. But technically, the people there are making the money to satisfy themselves, or excuse me, to live in those properties with no problem. So I don't know. The other thing that he doesn't have here that he's not listing is what really caused the housing bubble of 2008 was the bad lending practices, the bad credit, right? And right now, that is not the case. And that was the big domino right here. So let's see. So here's the part right here. So why do some industry insiders think home prices declines are unlikely? For starters, the country outlawed the subprime mortgages that sank the market a decade ago. Not to mention homeowners are less debt burdened this time around. So back in 2007, mortgage debt service payments accounted for 7.2% of U.S. disposable income. Now it's just 3.8%. Like almost, there's just a little more than half, right? So people have got a lot more money right now than they had back then. So it would suggest that people aren't nearly as fragile and the market would be nearly vulnerable. So I don't think the price, he thinks that we're coming into an adjustment. What was the other thing he said here? Possibly a 10% decline is what he's expecting, but not maybe just certain markets. So what does that mean as real estate investors? Really the big thing that we're looking at right now are the mortgage rates, right? It's becoming more and more difficult for people to buy a house, particularly first-time home buyers and particularly middle-class America. They can't afford the house they could have afforded just 3 months ago, 4 months ago. So they're slowing down in their buying activity. What are they doing? Well, a lot of them are moving over to rent. And here's the article that just was released today as well. Or this was actually just yesterday. Inflation hit rental market as higher mortgage rates, limited supply pushes up prices. Is what they're saying. And I've been saying this all along. So you're positioned really well as a real estate investor by being a buy and hold investor. Because if the people out there, the first time home buyers, the middle class America, they can't afford to buy a house, they still need shelter, they still got to live somewhere. So they're going to go and they are going to rent. And that's exactly what this is saying. So the demand was competing for houses. And when we had, a house would hit the market and you had 15, 20 people all coming in and writing offers and bidding that up. Well, they've left the buying market and they've moved over to the rental market. So it's a really good time. If you've got some income property right now, it's a really good time to be a landlord. It's probably a really good time to go out and start looking to how to acquire. And us as real estate investors, if you don't have the finances or you don't have the mortgage rates, because that's making the cash flow a bit more difficult, this is a time to really sharpen up on your creative financing skills. I'm talking about subject to, I'm talking about seller financing or a combination of the two and doing the wraps. And what another good strategy is, your exit strategy would be the lease option, right? And finding yourself tenant buyers. And that's a lot of what we're going to be talking about on Saturday. So if you'd like to join us, please do. That's go over at flipthescriptworkshop.com. The other part that's um, right here is on Friday, it was revealed that the U.S. job growth unexpectedly accelerated in July, defying the fears of a slowdown in hiring, even as the labor market confronts the twin threats of scorching hot inflation and rising interest rates. So there's something really interesting going on, and I'm going to point two things out to you, actually three things really quickly, and then we'll be. But employers added 528,000 jobs in July. The Labor Department said its monthly payroll report released Friday, blowing past the 250,000 jobs forecast that the economists were forecasting. So the unemployment rate, meanwhile, edged down 3.5%. So it's really difficult to have a recession when unemployment is so darn low. And right now we're at 3.5%. And so the what I want to kind of point out to you is we just got this report that jobs are up, like almost double what we were predicting. But then you come over here and you look at the U.S. jobless claims, they hit an 8-month high. So the number of Americans filing new claims for unemployment benefits jumped by 9,000 to 251,000 the week that ended July 16th, the highest since November of 2021, and well above market expectations of $240,000, pointing up to a cooler labor market. So on one hand, we've added all these jobs, and on the other hand, we've hit an 8-month high in jobless claims. So, which one is accurate? And then we have this also. It's tough to see how we have both things going on right now. So a wave of layoffs is sweeping the U.S. here, and here are the firms that have announced cuts so far, from Shopify to Tesla. So corporations are laying off people like crazy. So Shopify, about 1,000 workers. 7-Eleven, 880 jobs. Vimeo, 6% of its workforce was laid off. Tesla turned 29 employees. Let's see. Rivian, potentially around 5% of its workforce. GoPuff, I don't know what that is, but 10% of its staff, it must be a big company. Remax, 17% of its workforce. Microsoft, less than 1%, so it looks like they've got some security over there. JP Morgan, over 1,000 workers. But you're seeing this in the news every day. Compass, 450 employees. The whole tech industry is laying off. Redfin, about 6% of its total employees. Coinbase, about 18% of its workforce. So we're having these massive layoffs. The unemployment claims are up, but we're adding massive jobs. So it makes it really difficult to kind of predict as to what is actually going on, right? But what I see it as for real estate investors, the simple concept of supply and demand, and I talk about this all the time, and if you've been here before, maybe I'm sounding like a broken record, but we just have too many people. In 2008, we had more houses and not enough people. And now those things have switched, where we've got too many people because the millennials have grown up. Now they're buying houses. It's the biggest portion of our population right now. The peak age of the millennial is 32 years old, and the average age of the first-time home buyer is 34 years old. So that means right there, that's just 24 months, and probably about 2 years after that. So we got 48 months of the most demand for housing that we've ever seen in the history of this country. And so if we see the prices go up and down, just understand it's being manipulated. It's being manipulated by the monetary policy. We can't suppress that we've got too many people. And so we're not necessarily in a housing bubble as I see it. I see we're in a population bubble, and we got to do something about it. So I see one of three things happening. Either one, the government is going to get involved and they're going to start building housing. I don't think that's going to happen, but that's one option. The second option is the government is going to have to start subsidizing builders to build more housing. Now, I see that as a possibility, but by all accounts of what's going on right now, they're not taking any action at this moment to make that happen. And then the third thing is we're going to have multiple families living under one roof. That's how the population is growing right now, and that's what the availability of the housing is. So that could lead to absolute chaos. And that could be, chaos and unrest in the streets, or it could be something much more subdued, but we see chaos at the voting booths. So we will see which way it goes, but we cannot ignore that we've got more people than we've got housing. And for me, from my perspective, They got to live somewhere. And so if they can't afford to buy, I would prefer that they live in my rental properties and they live in my income properties. And I would prefer that you go out there and make those same types of investments and they live in your income properties as well, because that giant competition that just left the sales market is now entered the rental market. Alrighty. So that's what I got for you today. If you'd like to join us this Saturday, go to flipthescriptworkshop.com. We're going to talk about me and a number of my expert guests of what type of strategies and what types of things and tools and resources and where you need to have your focus in this new economy that we're entering into. A lot of uncertainty and a lot of conflicting information, which makes me think that, there's some chicanery going on. But what we do know is everybody needs food, water, air, and shelter. And shelter is the one that we all have access to invest in. It's what the average person has at their disposal to create their wealth. And it's created more wealth for more people than anything else. And I think the next 48 months is the time to do it. Now, there might be some turbulence here over the next 6 months, 12 months, 18 months, who knows? But I think 2 years, 3 years, 5 years, 10 years, looking back, you'll wish you got started right now. I mean, just think if you bought 20 houses 20 years ago, where would you be today? Well, the big question when you ask yourself is, what will you be saying 20 years from now? All right. So that's all I got for you. Thanks for being here. God bless. Peace, health, and blessings. And to your success, I'm Matt Terrio. Living the dream. Take care.